As we look at this point, kind of mid to late February, and this changes day to day, obviously, because we're talking about individual stocks, but I will share that really of those large companies that make up the S&P, for the most part, all but one are not very exciting. In fact, so retail sales were down by the largest decrease we've seen in quite some time. We're going to be covering a lot around that here in this week's market update. I'm Brandon Steele, financial advisor with Mainsail Financial Group, and our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a bit of the noise along the way. And although we do have a shorter week this week in trading, there certainly is a lot to cover. So markets were closed on Monday for the holiday, but we had a very important retail sales number come out Friday before the long weekend. And that retail sales number, for the first time that I can remember in a long time, was actually down. So it was down 0.9% versus expectations of being down 0.2%. So market did expect a negative number here, but certainly not anywhere near what we saw. And if it helps to break this apart a little bit, I think it's really important, by the way. You've heard me do this a lot on the inflation side of it. I'm going to do it here today on the retail sales, because we get these broad data points, but the question is like, what does it actually mean? Where is it coming from? And so I wanted to break this down a little bit and point to some of the primary culprits that drove this pretty, significant negative number. Those primary areas were sporting goods, music, and bookstores. It was online outlets, motor vehicles and parts, and furniture and home furniture stores. So for what it's worth, of the different kind of pieces that make up this pie of retail sales data, those were the, let's call it, four areas that really drove most of that downward pressure. All right. If we strip out autos, retail sales dropped by 0.4%. So obviously takes a good chunk out of that, but nonetheless pretty high still. And then on top of that, we had the Fed minutes come out on Wednesday from the January meeting. Minutes were, pretty in line with probably what you would expect based on the decision and the press conference to follow there last month. But the short version of it were the minutes primarily highlighted higher inflation pressures that they were seeing and concerned of at the Federal Reserve. There was a lot of conversation, very likely on hold until inflation improves. Again, I don't think that's probably much of a surprise. They likely would have done something with rates if that weren't the case, but obviously that's a big focus. And with the huge inflation numbers that we got pretty recently, speaks to where policy could go from here. But obviously we'll wait and see what happens, because that can change very quickly. The other thing I'll mention is that there's a lot of concerns around tariff impacts to inflation cited in there. For those who didn't see last week's market update, feel free to take a look at that. We actually had a really good question around tariff impacts to inflation and broke that out into more than just the surface level perspective on how tariffs might impact inflation, and expanded on it a little bit more. So definitely take a look at last week's update for any extra context if that helps. But those were kind of the three main focal points, I guess, in the Fed minutes. So again, quite a bit to cover here this week, although it was really two main data points or two main headlines. They were big. And I think the last thing that I want to cover today is actually to wrap this up into a broader perspective around the markets year to date. Before I jump in, be sure to tune in next week. Coming up, we'll touch on consumer sentiment and confidence, as well as new and pending home sales. So consumer and homes, I guess, is kind of the theme for next Thursday. But before we break, we have a great question from Ken around kind of an update, I guess, so to speak, on what's driving market performance this year. Because for many of you, you may be aware that, let's say 2021 or 2023, excuse me, more specifically, and especially early stages 2024 kind of held up throughout the year, but was really driven by the Mag 7, right? These giant companies. And I wanted to share kind of where we stand in 2025 on this, because one of the things that started happening late last year that was kind of swept under the rug to a degree was, if you broke the year apart, what we started to see is other stocks were starting to really do much better, which is pretty typical for a late cycle. We see the market broadening out. And it's something we've been paying a lot of attention to, and something we've been kind of addressing with clients' portfolios. As we look at this point, kind of mid to late February, and this changes day to day, obviously, because we're talking about individual stocks, but I will share that really of those large companies that make up the S&P, for the most part, all but one are not very exciting. In fact, I think technically now a lot of them are flat or slightly up. But when I was looking at this just a week or so ago, they were all down actually in that period. And the only one that really stands out is Meta. So Meta has had a great start to the year here in 2025. But otherwise, most of those companies are really lackluster is probably a good way to put it. Yet the S&P, as it stands, I think as of yesterday, is up about 4% year to date. So for what it's worth, I think this is something we've been talking a lot about over the past 9 months or so, and certainly something that we expect may continue as the year progresses as well, where instead of just these large companies that have really driven so much of the S&P's performance looking backwards, I think we'll start to see the other 493 carry their weight a little bit. Now, to be clear, that doesn't mean all of the other 493, but think about it this way, the way the S&P is weighted is that the larger companies have more of a hold on the total performance of the S&P index. So if those companies are not doing all that great so far year to date, yet the S&P is up 4%, that would suggest that some of those smaller sized companies, they're still huge, that make up the S&P. Some of them are doing very, very well to offset some of that difference. So very interesting kind of dynamic that's at work so far this year. Something we were just talking about as a group the other day. So it was a really good question. So obviously that can change. So keep an eye on this. This is not, a month and a half or so doesn't necessarily tell us the whole story, but it is absolutely something to watch and something that we feel may continue as the year progresses as well. Be sure to tune in next week. Again, the focus is really around the consumer and housing data. In the meantime, have a great upcoming weekend, and we'll see you next Thursday at 3.